Hello and welcome to Commodity Champions. I'm Manisha Gupta, and this week had all the makings of a potboiler where you had the US and Iran tensions escalating. We did see rhetoric, we did see attacks from both sides as well. And while there has been a bit of a de-escalation, the markets still are watching with a keen eye on what the next developments or next statements could really be. And that's not the end of it, because we have seen a reaction in global equity markets, a huge correction from the highs in case of crude and gold, where we saw multi-year and all-time highs, especially for gold in the Indian markets there. And the currency also seems to be now consolidating after that huge amount of volatility. What we are looking forward to now is the US and China Phase 1 trade deal that is expected to be signed on 15th Jan, or around that is the view coming in from the US President. And the Phase 2 deal now would be signed after the US presidential elections, that is in the month of November 2020. So yet again, there is plenty to watch out for in this year, especially in sense of the geopolitical tensions, the financial markets recovery, the trade deal to be signed, and the geopolitics just about continues to be on the surface or below that. Joining us now to talk about all of that and in sense of price moves is Peter McGuire from Exim Australia. Peter, hi, good to have you. First of all, onto the crude oil prices. While we have seen some de-escalation and the prices have come off their 14-month highs, what is your sense? How are you watching this whole deal and the impact it has had on crude prices?
Well, first off, I think what we've got to look at is the de-escalation, and a sell-off has been, I think, it's taken the market by storm very much in the last matter of days. We've seen that huge run up and then you've seen the pullback. For mankind, I'm very grateful that there's been no escalation in retaliatory efforts from Iran, but that's not to say that something may eventuate or could materialise in the short to medium term. So that I can't rule that one out. As far as where we move forward from here, I think it's just a little bit of a wait and see where the rest of not only the day, the week and the month take us, but those geopolitical concerns, what the great forces behind that, and still the unknown with this Iranian plane. So there are so many components to this equation that's hard to suggest, where prices are going to end up.
So, Peter, what is your sense after the kind of moves that we've seen, a $6 off a range in the last 3 trading sessions? How do you look at the prices, and are you putting any forecast out?
Well, I think first off, from a trading perspective, I think many traders have had an absolute boom over the last matter of a week and a half from just that price volatility across the sector, precious metals, and of course what's happened with the crude market. So big run up. If you're looking at the fundamentals and the technicals, it's been just extraordinary, and then that reversal, and traders have been, shorting the market. So from that side of it, it's been incredible moves, and that's where profitability, the opportunities arise. As far as price, I think it'll be a consolidation over the next matter of a week or two. I think you wouldn't be surprised that it bounces $1 or $2 to the upside from here. I think it was overbought and it was oversold, so I feel as though that could be the short run. And then as far as pricing by the end of the month, I wouldn't be surprised to take, maybe another couple of percent either way from these sort of levels, and as long as you don't get any further geopolitical shocks, Manisha.
So would you say that we are going to look at a consolidation here? Do you see prices moving beyond 71, a level that we have seen in this week already? Are you looking at levels of 75, 80, anything beyond that, or are we done for the highs for the near term?
I think they'll move further up. If you strip out from a geopolitical side, then that certainly is going to, I think, allow the market to track forward a little bit further than here. 70 might be a little bit of a handbrake. Let's just see where the market takes us over the next, week or two. But there are so many different components to this that it shows the fragility of it, that markets can move very, very quickly when you see, these sort of actions take place.
Okay, that brings us to gold then, and we saw 7-year highs in the global markets for gold. We saw an all-time high at 41,300 in the Indian markets as well. What is your sense now for the gold prices? Are we done the reaction here too, or are you a buyer, are you a bull when it comes to gold?
Well, it's been an incredible, matter of weeks on the gold market. It's been extraordinary, actually, and it's been a great year. So I feel as though that 1,600 handle US dollar was probably a resistance level there. Well, I wouldn't be surprised to see it edge up a couple of dollars over the, I think it's probably come off a little bit, but I wouldn't be surprised to see it edge up a little bit higher from where it's currently sitting. The uncertainty as far as US dollar, I think that'll come off a little bit, so that'll push gold higher. And again, there's every chance you could see a 16.25 handle for gold over the next, matter of months, quite simply because possible rate cuts and the uncertainty with Fed, I think, is putting a level of horsepower behind gold itself.
Peter, I would also want a gold price view from you because most banks and brokerages still reiterate that 1600, 1650 is a range that the gold prices could be averaging around for this year. Does your opinion also fall within that range?
Well, I think you're going to be around those sort of levels. I wouldn't be surprised to, that's, say, 1600 to 1650. I think it's got the capacity on what we experienced last year in 19. So, yes, I would think that there's every chance you're probably in that bandwidth. Very, very conceivable. And if you did see any form of correction, and I'm not suggesting you're going to, but equity markets are very, very frothy, as we've seen. It's just a continual build day in, day out, another record. I think, it's incredible. So if the market came off a matter of percent, I think that'd be enough horsepower to drive gold even higher. So you've got to keep your mind very much aware of that side of the market also.
The other most important factor clearly would be the currency markets, and the dollar index has reacted on both sides of the news and data and the expectation in this year where economic recovery really seems to be the top point. How are you looking at currencies as a sector to perform?
It bounced a little bit over the last couple of days. It's back at that 97.40, I think. I think it'll come off again, probably that mid 96s. It's whipsawing all over the place due to price volatility, and it's just extraordinary what we've seen. And I think there's further softness for that in the short term.
The other sector I need your attention on is the metals, because the US and China trade deal in the next week clearly has been seen as positive. We've seen the metal prices already react to that. And then it is also about the other fundamentals, because we are looking at decline in inventories. We are looking at better economic data. We are looking at better demand prospects too.
I think fundamentals are going to be strong. I think, this year and rolling into the next couple of years are going to be very strong growth. It's a depressed market. It's been sold off savagely, and I feel as though it's the base metal market is really going to come to the fore.
All right. Peter, my last couple of questions really are slightly tricky. I really need to know on how are you looking at allocations of money when it comes to various asset classes? So the first one really is, how are you looking at various asset classes? Is it going to be equities, commodities, bonds, debt market, currency? Which one do you see better performing in this year?
Well, building on 2019, it'd be hard to walk away from a bull market. So I think many traders have still got a very close eye on the equity markets, pretty much globally. And then looking at currencies, the US dollar, where does that trend and what impact it has to all of the cross rates. And then the Brexit market, probably some action there as far as performance of the pound. You can't take your eye away from gold in the short to medium term. It's had such a strong push up, and there's further potential there to be across that market and a number of the commodities, from energy straight across to the base metals. So I know it's a broad range, but the market seems to be in lockstep, that it's all moving onward and upward, and that consumption is coming back. So I feel as though that many traders will look at those sort of opportunities to continue building on 2019.
And my final question really is about allocating money within the commodities. Is it going to be precious metals, energy, or the industrial metals where you see more safety, more returns going forward?
I think many traders would be looking at the gold market because they see further upside and the potential weakness as far as US dollar. If we're looking at the crude market, we've seen that huge volatility over the last week. Gives us some sort of an idea how a market can trend so quickly and then wash out. So I think that's the attraction, but many traders look for the fundamentals and the technicals to align. And then from the base metal market, I feel as though there's plenty of potential there for that, for copper, nickel, and generally strong consumption over 2020 and leading in. So I'd be very favoured for a number of those base metal markets.
All right, Peter, we'll let you go at that. Thank you so much for joining us. So clearly the precious metal sector stands tall. We've seen good gains, we've seen some correction, and there could be some buying that we could see coming back in case of gold, and further highs not ruled out for this space.